Welcome all. Steve Parisi here with IBC Global. Appreciate everyone tuning in to today's podcast. We have one of our favorite guests and a good friend of mine today with us, Denzel Rodriguez. Denzel, how you doing, my friend?
Hello, Steve. Good afternoon. God bless you. God bless everyone else watching. Thanks for having me again.
Yeah, absolutely. How are things down in Florida, man?
I think there's a storm coming our way. It's hitting Puerto Rico right now. So, you know, typically now that I've been here for over 10 years, like
Yeah,
I sleep through these things now.
yeah,
But every now and then we have to pay attention,
yeah.
see if it's going to actually touch ground or not. But that's about it. That's going on down South Florida. Other than that, we're like a hotbed for COVID.
Yeah,
So staying safe, avoiding, big parties or meetings
yeah.
with people. My girlfriend got invited to a party, but there was gonna be 30 people going to a house, and she was like, "Nah, we're gonna skip that one."
Good move,
So I
in
was
my
like,
opinion.
yeah, let's. I know there's a lot of controversy on what this thing really is and who's getting hit and how did it start and all that good stuff. And I'm like, you know what? Not gonna worry about it, but I'm not gonna put myself into a potential dangerous situation if I don't know all the facts.
Yeah,
'Cause
yeah,
who knows? What if 50 people show up? You know what I mean?
yeah.
So
I'm with you, loud and clear. I mean, we've been keeping clear of everywhere. I mean, I'm in the office every day, but it's pretty easy in my commute. And a few people are in here, but my wife and I have just been playing it safe. I mean, not going anywhere with big gatherings and such until things kind of calm down. Cool. Well, glad to hear things are going well. Well, today we wanted to talk more about cash value life insurance, really infinite banking, velocity banking, how the two mesh together, how they work. They do work very well together, but really how to approach it, especially if you are in a position where velocity banking, you're looking at it and saying, hey, this is perfect for me because I'm trying to get out of debt, accelerate my financial position. I love this idea of infinite banking because the whole idea of the line of credit, they work well perfectly. They work together perfectly. But you're talking about today specifically when to start, or do I start with velocity banking and infinite banking at the same time? Do I do one first? What's the best overall situation? Just generally speaking, because everyone's situation is different. I get that 100%, but this should be fun just talking about the two. And when it comes to velocity banking, who better to talk to than you?
yeah. So just to kind of lay the groundwork, the foundation of which one to do first.
Yeah.
What I always like to tell the majority of people that are watching is number one, velocity banking, infinite banking are not common concepts.
Hmm.
They do have a bit of complexity to it. It takes research, it takes time to fully understand what it is, how it works. And then there's the formation of the actual process. How do I make it work in my own finances? How do I improve and add it as a feature and benefit to what I'm already doing? So I like to say, all right, majority of people already know what debt snowball, debt avalanche is, or making extra payments. So whenever we interact with people, I always kind of keep that in mind. Well, what have you been doing prior to velocity banking? What have you been doing prior to infinite banking? Once we get those details, I get the numbers of the individual and I say, all right, based on how much your cash flow is consistently, conservatively, each and every month, how much money you're bringing in, what your credit score is, what your total output. We're able to cater a plan to say, all right, right after you, let's say I'm dealing with someone that has been doing debt snowball, debt avalanche for a little while now. They've been paying off some debts. Maybe they've been knocking out some credit cards, but they still have a bunch of loans, student loans, and their mortgage and car loans and the whole nine, right? So what I like to do is look at their credit and say, all right, where's our credit score at? What kind of debt tool or AKA debt weapon that we can attain? Does it make sense for me to jump right to infinite banking? Most of the time, with the type of people that I deal with, it does not make sense to jump right into infinite banking because they don't have a lot of cash flow. They don't have good credit. They have a ton of debt that's holding them back from, funding a policy. So I kind of came up with some qualifications over the last year or so that I've been using now for my own clientele, people that pay me and people that want to work with me. So those qualifications start with consistent, conservative monthly cash flow of $1,000 to $1,500 or more per month. So whoever's taking notes, write the stuff down. Consistent, conservative monthly cash flow of $1,000 to $1,500 or more. This is free cash flow. This is money that doesn't go anywhere. This is not, we're not taking from money that you save. We're not taking from money that you invest unless the client wants to redirect money that they're putting into their 401k or money that they're putting into savings into infinite banking. And now they're going to call infinite banking my savings plan. Different story. But if I'm dealing with someone that has their 401ks, they have their IRAs, they have their rental properties, they have savings, emergency fund, what else is left over? That conservative monthly cash flow, 1,000, 1,500. The next thing is initial capital or savings. Does the individual want to use their savings and, like I said, repurpose it for either velocity banking or infinite banking? So depending on that, I look at initial capital, savings, and what I like to do is look at it above the normal emergency fund amount that they have. So if they have an emergency fund that they like to keep at 5,000 or 10,000, then I'm only going to look at what's above that number that we can use for velocity banking or infinite banking.
Sure.
Then the third thing, which is required for velocity banking, not really required for infinite banking, but it's required for velocity banking, which is the debt tool, or AKA the debt weapon, which is a home equity line of credit in the first or second position, a personal line of credit, either unsecured or secured, revolving, and then in addition, using credit cards at 0% on purchases and balance transfers. We like those things. Those help accelerate high interest debt, shifting it to no interest or very low cost of transfer.
Mhm.
So that's specific to velocity banking. You obviously need a debt tool
Yeah.
because you're graduating from debt snowball, making extra payments, and now you're graduating to velocity banking, which is using the bank's money, low interest or revolving simple interest debt to tackle high amortized debt or loans that are sucking up your cash flow. So not only are we having an interest savings by using debt to pay debt, we're also getting to the cash flow faster than debt snowball. So all we do as velocity banking practitioners is we simply run our numbers against debt snowball. So if someone has $500,000 of debt, and that's mortgages, car loans, student loans, personal loans, credit cards, and doing that snowball, they ran the numbers pretty easy. You just, what's your cash flow and that, to the smallest debt, and you just keep piling on one after another, hence creating the snowball effect. Well, if doing that gets me out of debt in 9.5 years, I've got a standard of measure. Here's how long it would take me to get debt free doing the traditional method. All I have to do is find a debt tool or a line of credit or a HELOC at a low interest rate, preferably below the rates that I have on my loans or debts. Even if the rate is higher on that line of credit or debt tool as opposed to my loans, there is many situations where it does actually save you money,
Yeah.
which can be a bit of a tongue twister if I say put that 4% amortized loan in an 8% simple interest line of credit. They're like, wouldn't I pay more? And that's not actually the case when we run the numbers based on how we're using that 8%. We're trying
Correct.
to reduce
Mhm.
our cost of borrowing to near zero with the help of credit cards and with the help of all of our income getting parked into that line of credit on a day-to-day basis. And the fact that we're getting to the cash flow of that loan faster and the interest also helps with, the overall equation. So just to recap, conservative monthly cash flow, 1,000 to 1,500 or more, initial capital savings above the normal emergency fund, a debt tool preferably, or required if we're doing velocity banking, not required if we're doing infinite banking, but it's preferable because it can help accelerate the max funding amount that we're allowed to do in a policy. And then I usually say about the last point is about 1 to 2 months of research, knowledge, understanding, confidence in the concept. You're running the numbers. So going back to my example, if it took you 9.5 years conservatively to get out of debt doing debt snowball, okay, velocity banking, we want to be able to do that in about half the time. We want to bring that down to like maybe 5 to 7 years, going at least 30% faster, or as high as 50% faster, right? Then I'm doing the same exact thing that Debt Snowball does. I'm just leveraging what the banking products that are out there.
Correct.
I'm leveraging those tools to my advantage. I'm copying what the banks do to our own money in our own checking accounts. For every dollar we put into a bank, they're able to multiply that 9 to 20 times over. So all I want to do is at least be able to leverage my money more than once. So I take $1 and I turn it into 2. How do I use $1 more than once? If I can do that, I can easily take that snowball and cut it in nearly in half,
right?
Or at least a third at best, right? Minimal results. So that's the framework. That's what I like to initially, work with and tell clients. Here's the framework. Here's the foundation. We have to make sure our numbers make sense. We're not just doing it because we came across a cool concept and this guy said I could be debt free in 5 to 7 years and yada yada. I watched 2 videos. I go borrow a line of credit, but it's at 18%. Okay, you're gonna mess up the whole concept already.
Right.
Because there's tools out there that are at 4, 5, 6, 7, 8%, super low introductory rates. But we need the credit, we need the income, we need the discretionary cash flow to actually make sense of that so that we can, operate.
Yeah, no, really appreciate that overview. And I appreciate the fact that you mentioned when you take velocity banking and infinite banking, people like both ideas and will state, I want to start both, but you'll say, hey, it doesn't make sense to start IBC infinite banking first because we've got to address your debt. And, when you look at infinite banking, if you were to summarize it or give the 30-second elevator pitch, it really, one, teaches one how to use a cash value life insurance policy as a financing tool, which is great. But then 2, the concept itself revolves around taking control of the banking function and not relying on third-party lenders, banks, and having that control yourself. And, because I know you and I have talked about this before, where usually it's one or the other. When you talk to a lot of other individuals, it's velocity banking versus infinite banking, and then they fight each other instead of just extracting the ideas that work well and seeing, okay, how do I use everything? There's no one ways, that's the way, and that's it. At least that's how I feel with everything. It's more so, okay, velocity banking does something that I love in the sense that you're leveraging other people's money, banks and such, to accelerate your time in getting debt free. I love that because in my mind, if I'm debt free, it does 2 things for me. One's the cash flow, right? I've got more cash flow, I can operate, but more so, what's more important to me personally is peace of mind. If you don't have debt where you've got to worry about these payments, and I lose my job, maybe I own a business and COVID hits and it impacts my business more severely than others and my cash flow decreases, if you're debt free, you don't have to worry about that. So I love the fact of accelerating the debt payment, getting rid of it, cash flow's freed up, I've got peace of mind, so I'm not worrying and spending all that mental energy, call it mental equity. I just made that term up. I don't know if that makes sense or not, on the debt. And now, okay, now I'm free. Now I can just put the pedal to the metal, and now you can really apply infinite banking more so, because if you're debt free, you've got cash flow to work with. And on some occasions, it makes sense to start a policy first to help wipe out other debt and such, especially once it's capitalized and I've got that cash value at work for me. But I appreciate that about you, where more so you say, okay, let's focus on the debt first, not just open up a policy real quick, where you see that out there, just because you can do a lot of good with the policy. And yes, you can try and spin the numbers to make it make sense right off the bat, but it's more so like, if it doesn't make sense, I'm going to be financially hurt by starting today instead of a year from now, 4 or 5 years from now, and just you telling me that up front, just being straight with me like that. I'd appreciate that more than anything else, because it's my financial well-being. So I'm glad you mentioned that, because I know in the IBC Infinite Banking world, I mean, I was part of the institute, the Nelson Nash Institute, for about 5 years, a little over 5 years, and it 100% focuses more so than on the dividend paying whole life insurance policy. The focus is taking control of the banking function, not relying on banks and third party lenders. So I love the fact that, okay, well, let's get my need to rely on them out of the way first, wipe out the debt faster, because time's money, baby, and then I'll start the policy and go even faster, because that becomes my line of credit.
Yeah, definitely. I think what what will help a lot of people that are beginners to this is the do's and the don'ts
Yeah.
of velocity banking and infinite banking, and some of the pitfalls that can occur that we don't account for, which most of the time is human error, and then crisis or events that we have no control over, such as COVID, or such as a job loss, um, getting hurt, not being able to work, business revenues go down, profits go down. So when we project a policy, oh yeah, my cash flow is, you know, this, say 50,000 a year total. So I want to put 50,000 into a policy. It's like, wait, where is that money being used? What's it being used for? Is it free? Does it have no purpose? Right? We want to really identify, where all of our dollars are going, so that we can make an educated move. And I know a lot of people, because of the videos that we put out, the videos that I put out, can make someone think more than what I said in the video. So they try to become smarter than the the conservative view of where I'm, presenting it, because I'm keeping in mind of other factors that I may not mention on the videos that I give right away. It's trying to go as deep as I possibly can in the allotted time that I do in that
Correct.
video.
I know what you
But
mean.
you've got people out here that will say, okay, what if I took out 100,000 of equity in my home, threw 100 grand in the policy, 1090 split, I'll have 88,000 or 89,000 or so, maybe 90 to, work with. And then of that, I can only borrow 90%. So now, let's say I borrow 80
20
out,
grand hit.
you know,
Yeah.
yeah, I threw 100 in at, now on the HELOC, it's 4 or 5%, whatever. So I'm doing velocity banking with that. I threw 100 in, I take 80 out, I throw it back into the HELOC, and I just do velocity banking on that. And I'm like, well, what the hell did you do? Like, we didn't actually pay off any debt. All you did was borrow the bank's money, start your own policy. You borrowed it out to pay back the bank at a higher interest rate. When maybe the better strategy could have been, you take the 100, we borrow only 66% or less of what's in there, establish the infinite banking policy, borrow out of the policy, pay off a $20,000 vehicle at 8%, which was costing you $500 a month. That's an actual gain. It's like, okay, there's still cash value in the policy. I only took 20K out. I paid off a high amortized debt. I got cash flow. That 500 a month can now go into my HELOC that I initially borrowed from, do velocity banking on that, get that wiped out before the anniversary date of the policy, so that I can do it again, rinse and repeat.
Yeah.
And so what ends up happening is I try to teach clients, okay, whatever we're funding the policy with, we have to make sure that we can cover the costs, the fees, the startup costs. People need to be aware of that, that we're not trying to build a policy little by little. Like, we want to start big because of the costs that are involved with it, especially if we're going to tie velocity into it.
Yeah.
If we cannot do that because of our initial numbers, right? My cash flow is only $500 a month. We don't have a whole lot of wiggle room. That's when I say, okay, let's put infinite banking off to the side. Maybe we do it in a year or 2 years or 6 months. Let's wipe out your car. Let's wipe out your credit cards. Let's get the cash flow up. Let's learn the concept. Let's master leveraging, because that is a very uncommon thing to do,
Yeah.
is leverage when we've been taught to avoid debt like the plague.
Correct.
Right. And we've been taught to, if you have $5, that's all you have is $5 to pay for a particular thing. Right. But you're living in an environment where the $5 doesn't actually is not even worth $5 anymore. It's worth negative dollars today. So that's why having debt to back up your actual cash can help us accelerate, go faster, because like you said earlier, time is in fact money.
Yeah.
So going back to that example of doing Debt Snowball, becoming debt free in 9.5 years, if I can do velocity and infinite and get done in 6, then we would have achieved the same thing that Debt Snowball did, but just faster, by 3.5 years, 4 years. But not only that, I now have an additional 3 to 4 years on top of that individual to create wealth. And not only do I know how to create wealth with just capital, but now I know how to leverage money like corporations do, like wealthy families do, like the banks do, and not lose. Right.
And that's probably the greatest value, just learning what others are doing that are already extremely successful and good at it. I mean, I've paid, call it business coaches and mentors, a lot of money for initial consults. And the reason for it was to pick their brain, learn what they're doing, so I can extract the ideas I like, copy it, and apply it to my personal situation, business, and move forward. So that last piece, what you'll learn in the process of how to pay off debt, how to get yourself in a better financial situation is great. That's the product, but the knowledge that you'll actually acquire, and then when you start to teach others about it, now you're talking, man. Like that's where you start to spread. Yeah. Now I like that. Yeah. So a couple of things you'd mentioned on that, because my background, I'm by no means an expert or well-versed in velocity banking. Anytime someone asks, I refer them to you. We've got content on that promotes you for velocity banking, because I'm not going to try and do something that's not my specialty. I'm not. Our specialty is really being laser focused on cash value life insurance. And that's from the days designing policies for corporations, executives, understanding the ins and outs. Point to it is, a lot of times when I'll have a conversation, or one of my agents have a conversation with someone that's practicing or interested in velocity banking, or they don't even know what they're looking at as velocity banking, but they're using, or they have the intent of using a policy to wipe out debt. Like, my conversation will be then, because this is like where my analytical self goes with a policy. I'm like, all right, you can use a cash value life insurance policy to pay off your debt. You can absolutely do that. However, the thing that you want to be aware of is, when I start a policy, right? If you use the example you mentioned, I pay $100,000 in there. I have, call it 88,000, 90,000 in cash value immediately. So no matter how I spin that, I have a death benefit. I purchased that life insurance, but I've got a negative hit, right? Call it 10 grand from my actual deposit. I took a $10,000 hit. That is a negative return no matter how you spin it in the first year. Now I'm going to borrow from the policy, have loan interest that goes to the insurance company, where in the first year I still have a negative return on that policy, and clear my debt elsewhere. Now, is it high interest credit card debt? Might make all the sense in the world. Is it a 3% line of credit? I don't know that I would do that. Point being, I mean, every situation is different, but just that awareness, because kind of what you had alluded to before, you see this concept, it's so cool. I want to get involved and do it because I can copy conceptually what the wealthy do. Yeah, definitely can. However, when you look at the actual numbers, does it make 100% sense to do it now? Or maybe I wait 6 months or a year until I can address the debt properly, and now you can just move ahead full steam. And that's important, I think, today, just in the high information age, and people wanting to move fast, instant gratification. And I do the same thing with business. Speed is everything. The faster you move, the better you're going to do, like Amazon and such. But at the same time, you've got to sit down, study the numbers. Either if we can do it ourselves as a consumer, or have someone to do it for us. If it's on the debt, I mean, that is your specialty. I've seen the math and boards. I love the whiteboard presentation you always have. That's great. Or if it's the policy mechanics, structuring the policy, how do I maximize the cash value? How do I make it flexible? We can talk about that next. As far as the flexibility, that's huge with a life insurance policy. A lot of times people don't know that around the flexibility. But being awareness is key. Early years, we've got that negative hit. If it doesn't make sense, it's just letting the individual know. Don't try and force the policy, because then if it feels like a burden down the road, we have buyer's remorse. I wish I didn't do it. Somebody else told me I shouldn't have done it. I think Denzel or Steve are jerks. I never had this, but that stuff, it can happen. You want to prevent that. And that,
Right.
I guess we could just say, do the right thing and it'll all work out.
Correct. No, that's definitely true. And that point of having a negative hit on a policy, the client needs to be aware, like, this infinite banking isn't the end all be all strategy.
Yeah.
This isn't going to make you 10x income. It's not going to 10x your income off the bat.
No.
So we want infinite banking to be a feature and benefit. We want it to be improvised, improved upon what you're already doing in your finances, not a hinder to what you're doing. Right. So I know I got clients that are like, oh my God, I'm just going to run all my bills through IBC. And I'm like, okay, if you spend 50 grand a year, the lowest we can have is a 5K base premium. And then we got the term, and then we got the PUA fee. And it's going to take a couple of years to actually net have 50K
Right.
a year to actually be able to borrow from. So what are we actually doing? Like, don't get confused with the numbers, right?
Correct.
You do want to make sense of what you're doing and make that transition. That's the key thing that I like to lay out with my clients. And I'm at the point where I don't entertain like uneducated individuals. We can't have an intellectual conversation with each other. It's not that I don't like the person. It's not that I don't want to work with them, but you do need to research. Don't just look at me. Don't just look at Steve. Look at everyone, right? And see whom you like the most.
That's all.
And how they're talking and why, and where do they come from, and what is their prior knowledge, and what are they saying and why, and just keep asking why questions, and what and how and who and where and when, because that's going to ultimately give you the confidence. Because it's one thing for the concept to be true, right? The concept of velocity banking is true mathematically. The concept of infinite banking is true mathematically, right? Infinite banking, velocity, debt snowball. But if the user does not know how to apply the material, it's kind of like someone reading the Bible and just getting a totally wrong interpretation or doctrine of it, or any book for that matter. Like, you read it, you got the wrong, you interpreted it incorrectly because you didn't know the definitions, you didn't know the terms that the author was using. Then you end up in a bind. You end up in, out of alignment, and you're wondering, how come everybody else is doing it? How come everybody else is succeeding with it, but I'm not? So I always try to look within the client. How is the user? Does this velocity align with you? Because sometimes it may not. And I'm totally fine with saying, okay,
That's
velocity
fine.
banking doesn't align. Guess what? There's that snowball. that snowball aligns with the whole world. I mean, it's pretty straightforward. There's no arguing. If you pay extra to your debt, you'll get out of debt faster.
Yeah.
There's no way around that. There's no argument. The only other contradiction to that is instead of paying off debt, I go and 10x my income. I build a business. I get a job, a side hustle. I sell products and services, make a ton of money, and then just pay off the debt all at once. I could do that as well, especially if it took me 5 years.
Yeah.
As opposed to 9.5, it took me 5 years, let's just say, to 10x my income. Well, if I 10x, to pay off my debt, it's going to happen in one shot. And then I can really do infinite banking and velocity and,
Yeah.
adapt and change things up that way. So
I agree.
focusing on the individual.
No, and that's perfect. And kind of what you had mentioned there as well, where being educated, doing research, where some people will reach out to you or I or view our content, but call it our style and our means of communication might not mesh with the individual. And that's okay. I look at it, and this is just, I call it my thoughts on business and life, how they've progressed or changed over the years, where so often, and I'm sure you get this a lot, you'll hear from people in your field or business that there's a right way to do it and everyone else is wrong. This is how it should be done. And I'm like, there's so many different ways you can structure policies, you can attack debt. It's, hey, here's one way to do it. We can show you several options, and it's ultimately up to the consumer. But I guess call it, you don't do this at all, and I appreciate it. It's one of the reasons I have podcasts with you and not everyone, is just negativity when we see other groups. I've seen people negatively attack you to say your strategy doesn't work, and just ignore them and keep doing your thing, which is perfect. I mean, that is just going back to it, doing your own research, saying, okay, I like this individual. I like Denzel's strategy. I want to work with him. If it's for infinite banking and cash value life insurance, everybody's going to be attracted to a certain individual. But what will repel an individual is if you negatively go after them or even imply it. Think of it this way. Do you ever see Grant Cardone, Tony Robbins, who's another guy, Dean Graziosi, if I pronounce his name right, negatively bash each other or someone they don't like?
Not at that level. No way.
No. And that's the thing, like at that level. But they're normal guys, just you and I and everyone else, but they do not negatively attack other individuals. Do you see Amazon say, Walmart stinks, don't work with them, we have the best possible way of doing things? No, they don't do that stuff. Point being, you've got a great way of presenting, being extremely transparent, showing all the options. A lot of people will like that. And if they don't, kind of what you said, hey, that's perfectly fine. The education is always here for you. When you're ready, if you make the choice, I'll help you.
Exactly.
Yeah.
I try to keep it like that. And I also consider my age. I don't know it all.
Yeah.
Nor will I ever at any point in time. So I just know what works effectively. And I have this own little theory of mine in the financial space, which is every financial concept that is brought to the marketplace at a massive scale, or even uncommon concepts around finances. In my mind, I'm like, they're all true. Now that they're all true, which one is the most effective one for me?
Yeah.
And how can I proceed with that particular doctrine, that particular concept? How is that going to cater to me?
That's all.
Because if I get into the game making 6-7 figures already, that snowball may not be the best thing for me.
Right.
Because this is slow.
Yeah.
But if I make $3,000 a month and I only have 200 of cash flow per month, maybe I'm a single mother and I only make 1,500 bi-weekly, 1,000 a week. Okay, velocity banking may not be ready, for you.
Yeah.
Not that you're not ready for velocity. Velocity just may not be ready for you because, number one, you probably don't have the credit. Number two, you don't have the disposable cash flow to be, flip-flopping money around.
It's all custom.
And the mental capacity to handle all of that comes with velocity, which is why the argument on the other side is, oh, those velocity banking coaches and mentors, they're not accounting for human error. Most people just won't get it. And I'm like, yeah, most people don't. That's why I don't try to get most people.
Mhm.
Like really 10% of the population, I would say velocity banking is fantastic.
Yeah.
10%. Now, when you look at my channel, the amount of subscribers I have, you, and every other velocity banking coach or mentor, add that up all together would probably equal the amount of subscribers Dave Ramsey has
Yeah.
and Susie Orman. So those 2 million subscribers that Dave Ramsey has, those are the people that are right. Those people are probably people that have no capacity, mental capacity to handle debt. Number one, they were poor managers to begin with. They just were just ineffective managers of money. And that's okay. So I don't tell them that they're wrong, that they're dumb, that they're,
No. Yeah.
uneducated. I'm just saying, hey, there's levels to this.
Yeah.
There's levels to life. You start off here, you work your way up, you eventually get access to more and more information. What you'll come to realize is that the higher you go up
Mm-hmm.
into the hierarchy of finances, the more intricate, the more complex things get.
Yeah.
I love the KISS method, keep it simple, stupid. That only applies to a certain level. The
Mm-hmm.
minute we go up in life, that life is hard, life is complex. There is no simplicity in life. I'm sorry. There is no work-life balance. Like you're going to have uncertainty and volatility, and your ability to handle crisis, your ability to adapt and change and evolve
Yeah.
is what ultimately keeps you going higher and higher up in the world and ending up with, small population, 1 to 5%, while everybody else is trying to keep it simple.
Correct. Correct. And kind
That
of
is a tough thing
it,
to,
it,
you know,
it is
change.
100%. And on that point, I mean, where you say, hey, how do I get to that next level? Personal finance, business, whatever it might be. And what's interesting, I always relate it back to sports, is
Sports.
and what
Nice.
I'll what I'll always train my agents on, our staff on, when I talk to a recruit is, and I had to do this myself, is okay, where do I want to get? Or what decision am I going to make, a year from now? I'm looking at a purchase, whatever it might be. Am I going to do it eventually? Because you know yourself well enough. Am I going to do it eventually, or am I going to stall for 6 months before I finally click that button and buy it, or whatever it might be? And this is one of the things I got from personal coaching with Grant. He's like, just start making decisions faster, bro. I'm like, all right, I could try to do that. He's like, don't try it, do it. You're going to struggle with it a lot. And, I do. But when you actually apply it, make the decision quick and say, okay, I want to hit level 10. So I can either work my way up, but what if I just try and do it right now? Like you used to wrestle, right?
Yeah.
So imagine if you're in a certain weight class and they just bump you up 2 weight classes the next day when you're not ready yet. That can be tough.
Very. I have a funny story regarding that. I actually did go up a weight class to just simply because the way wrestling works sometimes
Yeah.
is if you're short on team members, as long as you wrestle in the class, you still get the point or whatever the case may be, and you can still compete or
Yeah.
qualify as a
Hmm.
team as a whole. So I remember we were in a tournament. I had already wrestled my class, my weight,
Hmm.
but then I was asked by coach to go up a class about 10 pounds, 10
Oh,
pounds in weight. Now, 10 pounds doesn't sound like a lot, but it is a huge difference in the wrestling world.
yeah.
And so I remember, accepting the challenge. I went all in and I ended up having a terrible injury, you
Ugh.
know? And I remember this kid was like, no, I think the weight class was 130 and I had weighed about 115, 114 or 118 at the time. And so I went up to his class, but he was at the max weight of his class.
Big
So
difference.
although it's 130, he was probably coming in at 135 or maybe 134 or something like that. Well, I remember wrestling with the guy and, his weight was on me and I remember falling. I stuck my arm out, boom, dislocated the elbow,
Oh,
dislocated my shoulder, fractured a little bone in my hand, and it was just game over for me.
went for it.
So that's, it's one thing to go for it and
Yeah.
fail forward, right?
Yeah,
And get
there you
back
go.
up. I
Yep.
healed, took me 2 years to heal, and I was back in it, and then I, eventually transitioned to a different sport. But the fact that some people in their finances, they try to do that, they break an arm, they break a leg, they,
You
so to
get
speak, in their finances,
stronger.
they shoot themselves in the foot. And, you know, now either they will stay down
Hmm.
or they're going to get back up and eventually jump from level 1 to level 10. Some people have the capacity to do that. Most do not,
Hmm.
because of fear,
Yep. Gotta try it.
failure, right? They tried it and failed. Like, I remember it took me a good 2 years to really learn velocity banking. 2 years. Took me another probably year or so, and even still to this day, to learn infinite banking. And
Hmm.
I'm still learning. So for us to try and teach clients in 6 months or less,
Yeah.
is no walk in the park for them or
Hmm.
for us. So that's why we encourage the videos,
Yeah.
watching, practicing, reading over and
Yep.
over again. If you want to be like LeBron, like
Repetition.
Stephen Curry, like,
That's all.
you're gonna have to take 1,000 shots,
Yep.
1,000,
Hmm.
10,000, 100,000. You want to be like Kobe, rest in peace. Like, you really need to dive into it, immerse yourself, and you will achieve the results that you want to achieve,
Yeah.
or live a mediocre life. You
Hmm.
choose it. Choose
Yeah.
what you want.
I'm with you there. Yeah, and kind of jumping up to that next level with that weight class, man, that hurt. Yeah, having to go through that. But how much did you learn, and how much in reality did it get you ahead of the game? You say, okay, I went and toughed it out, and yeah, I got knocked down, but now I know how to approach it next time, and now you're that much better and that much stronger, that much smarter.
I
Same thing
tell
with
you what,
finance. Yeah.
what really happened, that was one of the biggest takeaways from that, is the amount of respect that I had, that I was given by my whole entire team, the varsity, and I forgot what the
Yeah.
junior varsity. I was on the varsity team, and then there was junior. But between all of them and the coaches and all of my friends, the level of respect that I received because of what I did, I went all in. And I
Mhm.
was a newbie in wrestling. Like,
Yep.
I never wrestled a day in my life. I was a freshman in high school. It was a cool sport, liked it. And like, within like a first year of doing wrestling, I went from junior, immediately graduated to varsity. I was the only one in my weight class. So I was always wrestling in my own weight class. And then I eventually went up,
Yep.
and that was a tournament. So whoever I was wrestling had more experience than me, right? And I was still willing to do that. Had I stayed on the bench and been scared and not do it, right? What would that route have been?
You'd still be there.
Even if I knew going into it, hey, you're gonna break your arm if you do that. Even if I
Mhm.
knew it, and this is what people need to know, like, when it comes to your finances, you're gonna make mistakes. So you should know that, but still move forward.
Yeah.
And that's what I did.
I love that, man. No, not that's awesome. I'll share a quick mistake, and then we can kind of get back on track and wrap it up with policy flexibility. So with business and such, I mean, there was a time when I was newer, starting my own business, had branched off, was building it up, and have this big prospect. It's a business. They're out in the Midwest, and they say, "Okay, Steve, we're talking to you and a local advisor. We'd like you to come meet us." Now, I live in Pennsylvania. They're out in the Rocky Mountains. So I'm like, all right, I got to fly out there. And it's with the board. So I got to put a presentation together. I, spend a ton of money on going out there. Put the whole show on for them. Bombed the presentation, lost the deal, wasted money. I'm like, ah. But the point is, like, how I look at it is that failure And that's one of about 10 million, by the way. But that particular failure, that I remember because it cost a lot. And it was one like, man, if we get this deal, it's going to be so cool because they're a big company. A lot of people know their name. And then they get the CEO. We've gone another direction. But point being, learning so much from that example, that entire experience, how we prepared for it, everything, and just going for it too. And hey, you lose it, like, who cares? Just get back up. Try it again. I don't stop following up with them. Like that still don't stop. I'm not going to stop on that point. But the learning experience is key. And that you could call it a big financial foolish move, going out there. I would handle it much differently today. But at the same time, you live and learn with everything. But it's taking the risk. And the next time you do it, you know how to address it, and then you're successful. And every single individual that's out of debt has their own story. Every big company, they don't just all of a sudden have a ton of money. Like we're fortunate to hear some stories. If you look at Microsoft and Apple, how they started, that was no walk in the park.
Right.
Yeah.
Garage or something,
Up all night, grinding, failing, couldn't sell, but they got it. They eventually hit it when they kept pushing forward. So it's just getting up and constantly trying. You do that, you'll make it. I don't care how sharp or unsharp, for lack of a better word, someone is. It's like, if you've got a work ethic, you're going to be fine.
Correct. Yeah. And don't, these stories that we're telling for the viewers watching, don't think, okay, I need to go break an arm to make this happen.
Yeah.
You want to learn from Steve's mistakes. You want to learn from Denzel's mistakes. You want to learn from the other people's mistakes, so you don't repeat
That's all.
a mistake.
They made it for you. Yeah.
They did it for you already.
Yeah.
So now you say, oh, there's a hole there. Let me not walk over that. Mm-hmm. Even though it looks level, that bridge is not so level, it could break, whatever the case may be. Let me not go that route. So don't, going back to, finances overall, don't just jump into infinite banking because, I'll just learn it along the way. No, that was a mistake that was already done.
Yep.
We learned from it. We record it. We put it out there for the world to learn. And then you go and execute in an effective way.
Yep. Gotcha. Love it. Let's touch on policy design and flexibility just with our last bit of time here. So, and this fits beautifully with velocity banking too, because the flexibility is everything if life happens. So, I mean, when you have a life insurance policy, and this is one of my favorite topics around cash value life insurance, is if the average individual hears the word life insurance or just insurance, take the word life out, we think bill, premium. Same amount I pay every month, every year. Boring. It can work, but it's not attractive. It's not exciting. What you can do with most life insurance policies depends on the company and the flexibility. That's why we always look at different companies, is you can really take the boring insurance bill out of the equation and use it as a flexible savings asset. For example, if I want to have the ability to pay in $50,000 per year, but I don't want to get a bill for $50,000 per year, I don't need to commit to the $50K. Literally what you can do is set up a policy. Money can go where? Premium or a PUA rider. What particular insurance company am I looking at? How much money will they allow me to put into PUAs in excess of my premium? Some will let me 10x it. Some have no limit. Some are 3x. Depends on the insurance carrier. But it's being familiar with the different insurance carriers and saying, okay, if I want the ability to put in $50K, I didn't know I could commit to $5,000 per year. I could even pay that over 12 months. Right now it's under $500 per month. And then have the ability just to pop additional money into PUAs, accelerating the cash value growth and death benefit over time. Now I've really turned that policy into a flexible savings asset. And you plan it right with the premium limits, the MEC limits, make sure it never MECs, all that good stuff. But having that flexibility to say, I want the ability to put in 50 per year, 10 per year, whatever it might be, I can now commit to an amount that never feels like a burden and just throw extra funds in whenever I want. And then how that ties to velocity banking would more so being okay, or more so being I can fund this policy at my leisure. So as my cash flow gradually increases, I can now peel some of it off and throw it into the policy. And then I've got the whole line of credit idea. The money stays at work for me and start clearing the debt.
Correct. Yeah. A good example is like someone that has maybe a $50,000 personal line of credit or HELOC, and let's do the HELOC, 50K HELOC. That's how much equity they currently have in the home. And let's say we're doing velocity banking, we're chunking at car loans, we wipe out the car loans, we wipe out the credit cards, we wipe out all their debt on the velocity banking side until we get to the mortgage. By the time we do that, there's going to be more equity in the property, number one. Number two, if I go ahead and make the transition because I met the qualifications, I now have 1,000 or more cash flow. I have a savings and emergency fund. I have capital and I have a line of credit. Now I'm ready to do infinite banking.
Yeah.
If I design a policy where I say I want the ability to put in 50K, but I'm going to start with 25 because I only have a 50K HELOC, and I'm going to borrow 50% of it. I'm going to throw it in the policy. So I throw in 25 to start the policy. That's my what's called a chunk in the velocity banking world. So we're chunking at our policy, 25K. Okay, 5K goes towards the base premium, we have the PUA fee, yada, yada. Okay, whatever's left over in cash, we borrow maybe 60 to 75% of what's in there, borrow it out, chunk at the mortgage. So now you create more equity in the mortgage, right? Now you're in debt on the HELOC, 25K. We've got 1,500 or more cash flow. All of our other debts are wiped out, good credit score, we have savings and capital. We can now shift our emergency fund into the HELOC, right? We can now shift what we were typically saving into a savings account earning nothing, and we're going to shift it into the HELOC. We then shift all of our income into the HELOC. Maybe we get wife on board, so now there's two incomes working in that HELOC, bringing the balance down. Now, typically in the velocity banking world, when we make a chunk, we like to bring the line of credit back to zero or close to it within a 6 to 9 month time frame. Well, here's what's pretty cool is if I can do that, if I can bring that 25K HELOC back down to zero within 6 to 9 months, well then when I go to make another 25K chunk, instead of paying back my policy loan, I can go ahead and max fund the policy. I have the ability to do that as long as the policy is designed correctly and effectively and properly. So 25 initially went in. The desire was to get to 50.
Yeah.
Here you are 6 months later. You want to dump in that extra 25. Now you're at 50. What do? You borrow another 50, 60%, take it out, policy loan, throw it on the mortgage.
Mm-hmm.
You did 2 chunks in 1 year on your mortgage using infinite and velocity banking put together. By the time you reach the anniversary date of the policy, you can switch it to just a 5K base in case you're still working on bringing that HELOC back down to zero. So you say, all right, I'm just going to put in 5K real quick, satisfies that. As soon as the line of credit hits zero, right? And you do it again. Maybe a year from now, wife got a raise, husband got a bonus, cash flow went up, they're saving, their expenses go down because they're not spending as much because they're super excited about max funding their policy. Now they're making it fun. It's a system.
Yep.
The flow. Oh my goodness, this is starting to really work. So not only are we becoming debt free in a similar time frame as velocity banking, but now we have an asset that we're creating, a tax-free, compounded, uninterrupted interest rate that we get to bank on, the flexibility of borrowing and not having to pay it back. Not only are we not paying it back, within the first year or so, but it's zero borrowing costs. I don't lose whatever was growing in the cash value year over year. I don't lose that. As long as the policy is designed correctly and properly. I can make sense of borrowing, not paying it back, because I'm saving tens of thousands of dollars of interest on my high amortized mortgage loan.
Yeah, looking at the cash flow. And no, I hear you. And focusing on the cash flow, that's good. The thing that, and we can definitely talk about this on future podcasts when we go into policy loans and such, because that's something I'll always look at, kind of going back to the initial hit of a life insurance policy. When I have a loan outstanding on a policy and I've got cash flow, the question I'll ask myself and the individual is, does it make sense to dump money into PUAs and max fund it, or address the loan or loan interest? Maybe I split it and such. And if you pay the loan off eventually down the road, hey, everything's restored. It's great. It's good to be aware of how much we pay in loan interest to the insurance carrier. But it is interesting, especially for the analytical type that sits down and wants to know, hey, how do I just maximize every penny? There are times where I look at a situation and say, you know what? It makes sense to not max fund the PUA this year because, I've got 2 months left before my policy anniversary date, whatever. I should attack the loan first, or definitely the loan interest. And then if I have leftover, pay it into the PUA. And that's just when we've studied policies, illustrations, but really actual performance. That's what I'm always interested in. But it's interesting. I just wanted to mention that too, because I know there's a lot of, how can I put it, criticism out there in policy loans, where it is important to look at all the options there as far as max funding a PUA versus paying the loan down first. And if you're aware of the cash flow, which is exactly what you do, like I kind of look at it and say, well, you're good at the end of the day because you're paying it all off anyway, so it doesn't make a difference. But at the same time, especially if you're listening to this and saying, well, I'm interested on paying the absolute least amount of interest, I want to understand that. There are going to be times where it makes sense, especially in the early years of a policy, address some of that loan interest or loan first. And it's something we've studied. We've got some case studies. I don't have public at this time. In the future, we might make them public that go over exactly that.
I agree with that.
Yeah.
And, that goes back to how big is the policy going to be,
Yep.
and why. And ultimately, not only are we just designing a good policy that's going to be effective long-term, but what is the purpose of it? Is it going to be used to pay off debt? Is it going to be used to fund a real estate investment deal? Is it going to be used to fund your own business venture, invention, idea?
Yep.
Is it going to be used to just simply finance things like a car? Then you can make sense of leaving loans outstanding.
Yeah.
But you don't want to have that problem where the policy is not performing because you didn't max fund it. So now the loan is starting to get ahead of the cash, or it's now starting to play a bit of an effect on how it performs.
Correct.
So, we want to pay attention to that. We
Yeah.
want to look at all the angles.
All the fun stuff.
Yeah. And that's the whole point of taking 1,000 shots, being like LeBron when it comes to your finances. Like, it's your personal financial development. Don't fool around with it.
Correct.
Like, don't just leave it to Steve to figure it out. Don't leave it to Denzel to figure it out. No, you want to leverage what we already know, Steve and Denzel and others that you listen to. You want to leverage what we already know, apply it in your household, become masters over finances. You become good managers, good steward.
Yeah.
You live the life you want to live. You create that sole purpose, that lifestyle.
Right on, my friend. Cool. Well, we are definitely out of time, but good as always catching up with you. If you, those listening, have any questions, we've got our contact information at the bottom of this video. And if you're listening via podcast, we've got information on the links of how to reach out to us as well. But appreciate everyone so much for listening. Denzel, thanks as always for taking some time, and we'll talk to you soon.
Thank you, sir. God bless. Have a great day.
All right, you as well. Thanks. Bye. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.